Hello friends, a very warm welcome to my channel. As per your request, in this video we are going to talk about Jubilant Ingrevia. It is a specialty chemicals and agrochemicals company which is also into nutrition segment, and this company belongs to the Jubilant group, which is led by Bhartiya brothers. This is a very well known group in India, and most of the companies or the businesses in which this group operates are highly successful. New to the channel, please to subscribe and hit the bell icon, and if you are not a part of our Telegram channel, do join today as we discuss daily the market outlook in our Telegram channel and a lot of other interesting news and views. Let's begin the analysis of Jubilant Ingrevia. This will be the flow of our presentation. First, we'll discuss the business model in brief, then we'll see what's happening on the chart in this company in the last couple of years. Then the main financial parameters, we look at how the company has been performing in the last 2-3 years and why the stock has corrected so much from the highs. We'll discuss what is the growth plan of the company going forward in the next 3 to 5 years, and we'll talk about the valuations at present after the correction in the stock. After this analysis, we'll discuss what can be done for people who are already holding the stock or who are looking at a fresh entry in the stock. So this is the business model of the company. The company operates into broadly 3 segments: the specialty chemicals, the nutrition and health segment, and the chemical intermediate segment. So as the name suggests, the specialty chemicals are the value added chemicals where the company is making some niche products, and they are able to also pass on the raw material price hikes. The nutrition and health segment, in this majority of the business, close to 65% of the business is from the animal industry, and the chemical intermediates business is the intermediates which are ultimately used to manufacture other products. So these are kind of these are used as inputs to the manufacture of some of the products which Jubilant Ingrevia manufactures, and some capacities or the production is also sold outside. So in specialty chemicals, the company makes pyridine and derivatives, then fine chemicals. They also have a lot of exposure, close to 50 to 60% through the agrochemicals, and they also do CDMO, which is contract development, manufacturing and operation. So this is done on the behalf of other companies where they are giving contracts to Jubilant Ingrevia to manufacture and develop certain products. In nutrition and health solutions, they manufacture some products which are related to the animal health as well as human health. And in chemical intermediates, their main products are into acetyl chemistry and ethanol chemistry. So the company has a very well vertically integrated business model. 40% of the overall intermediates which the company produces, which is in the third segment which we discussed in the last slide, those are captively consumed by the company itself, and further the pyridine derivatives also which the company manufactures, close to 43% is consumed in-house and the remaining is sold outside. So it's a very well vertically integrated business model which helps the company into better efficiencies in production, lower costs and stronger quality checks. The company has global leadership in lot of products. They are number 1 or in the top 5 in several of the products which the company manufactures globally, which shows the quality and leadership of the company. They have more than 1500 customers and manufacture more than 134 products, and they supply to more than 50 countries. Out of these, more than 1/3 is sold to the regulated markets. So generally in the regulated markets, the approval norms or the quality check norms are very strict, so any random company will not be able to supply. So when this company has more than 1/3 sales to regulated markets like US and Europe, you can understand what kind of approvals this company already has, which is not easy to obtain for any other newcomer. They have 5 manufacturing locations and more than 50 manufacturing plants, and they are further doing capex in an aggressive manner in the next 3 to 5 years. And they have 3 research and development centers where more than 114 scientists work. So by this you can understand it is a research driven manufacturing company. Now when you look at the chart in the last couple of years, so this company was formed as a demerged entity from Jubilant Life Sciences, which was later renamed as Jubilant Pharmova. So they separated their pharma business as well as their chemical business, and the company which demerged with their chemical businesses is known as Jubilant Ingrevia now. So you will not have a very long-term chart of the company. Last 2-3 years performance at the most you can see. So it got listed below 300 as a demerged entity and shot up to almost 800. From there it has seen a very sharp fall up to nearly 400 levels. Later the stock started consolidating as the company was facing some temporary slowdown, a lot of margin pressures, and it has been consolidating since then. And in the recent results after Q3 FY23, the results were further lower than expected, and that is why there was another decline which is up to somewhere around 350 levels. And now the stock looks a bit bottomed out and started its upward journey. Is really the worst over for the company? Is the stock bottomed out? We'll discuss in the coming slide. If you look at the main parameters in terms of financials, I have taken the quarterly numbers of the last 7 quarters. The revenue has more or less stagnated, and in fact it has shown a decline in the recent quarters compared to earlier. So they have done a revenue of about 1158 crores in the latest Q3 FY23 quarter, which is not that impressive compared to the earlier quarters, and there is not much growth. So this is one of the reasons why there is stagnation in the prices or consolidation in the stock price of Ingrevia. When you look at the profitability in fact has seen decline. Earlier the company was doing somewhere around 200 to 300 crores of EBITDA on a quarterly basis, which has witnessed a sharp fall, and now it does somewhere around 150 crores, and the same trend continues in the last 4 quarters, and there is no improvement sequentially until now. When you look at the margins have again further seen pressure. Earlier the company was doing somewhere around 25%, but a lot of products which the company manufactures are cyclical or commodity type in nature, and that is why you will see that the margins will not be even in a longer period of time. During the good times, the company will get higher margins from certain products, and during the worst times, the margins will see compression. So in such stocks, it is important that you at least partially time your entry and exit and don't buy and forget forever. So right now the company is doing at EBITDA level a margin of about 12 to 13%. But what you observe in the last 3-4 quarters is the margins have been stabilizing now, and it seems like the worst in terms of margin pressure, in terms of raw material costs are over for this company. So as you see that the stock has fallen more than 50% from the all-time highs. So what is the reason for the fall? A few of the reasons which you have observed in the financials is the stagnation in the growth of the company, the pressure on the margins of the company because of increase in the energy cost of the company in terms of coal and other energies which the company consumes in their production. In the nutrition segment, as I said, it has exposure of more than 60% to the animal nutrition. So there has been a situation of flu in US and Europe, which is leading to lower demand in this segment, and in the key products which is vitamin B3 also the company is seeing subdued demand. So that is why the nutrition health segment for the last few quarters has been showing weakness. When it comes to their chemical intermediates business, which is the third segment which we talked about, the company has been witnessing lower prices of their products. So this leads to lower sale price or realizations, which in fact decreases the margins of the company. Products like acetic anhydride, ethyl acetate, these products have been seeing lower realizations leading to lower margins. And in a few of their capex plans, the company has also seen a little bit of postponement or delay. So these are the reasons why the stock price has fallen from their highs. Now if you look at the segmental numbers also, this is the 9-month numbers which we are comparing for FY22 and 23. In the specialty chemicals, you see that it is doing well. The revenue is up in the last 9 months by 40%, but the other two segments, which are nutrition and health segments as well as the intermediate segments, have been a drag. Specialty segment, although it has growth in terms of revenue of 40%, but still it is struggling in terms of profitability, as the profit growth is negligible. There is no profit growth in spite of the revenue growth. So this shows that the specialty chemical segment is also seeing pressure on the margins. And the other segments, which is the nutrition and chemicals, are also seeing a decline of profits by 60% and 40%. When you talk about the EBITDA margins, the 24% margin which the specialty chemicals was generating earlier is gone down to about 17%. The nutrition segment's margin has gone down from 20 to 10%, and the chemical intermediates margin has gone down from 18 to 11%. So there is huge margin pressure in all the three segments in spite of growth in revenue in the specialty chemical segment. In spite of all these pressures which the company has been facing, we should try to judge whether this situation is temporary or permanent. So the company claims that all these pressures in terms of margins and growth stagnation are temporary. Their capex plans are intact, and gives this outlook of growth for the next 3 to 5 years. Their vision is to double their revenue by FY27, and they have reconfirmed that the vision remains intact. Their plans remain intact in the latest earnings call. They have 35 new products in their pipeline which they will be developing in the next 3 to 4 years. And if they want to do additional capex, they have sufficient land available in their existing facilities. So there is not much investment required even if they have to extend some plant and machinery. In terms of value, they have a plan to spend about 2,275 crores in capex in the next 3 years, which is a huge number. And even if this generates an asset turn of just about 2x, this will generate close to 4,500 to 5,000 crores worth of revenue for the company. Presently, the company's business has more share of the bulk products which have lower margins or volatile margins, and going further, the company will focus on the niche products which have higher margins and where the company is able to pass on the increase in the raw material costs. So this will lead to better stability in the margins and higher margins for this business. Ultimately, it will lead to margin expansion. So the mix of specialty and the nutrition segment is set to increase in the next few years from 44% to 65%, and the bulk intermediate segment proportion in the total revenue will go down. By this, you can understand that the growth prospects of the company are good, and the management is also trustworthy as they have been into the markets for many decades in various business entities. Now, when you look at the valuations, earlier the stock was trading at somewhere around 2x times the market cap to sales, which has now fallen to just about 1.4 times. So for this pedigree of company, for this kind of products and these kind of capex plans which the company has, the valuations now seem reasonable, and more or less if the company is able to maintain this kind of revenue and profitability, even if they don't grow for the next 1 or 2 quarters, the valuations also look bottomed out. Now that you have understood the business of the company, the reasons for the fall, and how is the company expected to perform in the near future, what should you do as investors if you are already holding the stock or if you want to enter afresh? So if you are already holding the stock and have a time frame in the mind for the next 2 years or so, then you can comfortably continue to hold it. And in fact, if you are holding from much higher levels, gradually as you see improvement in the quarterly results of the company, slowly you can even average it. And if you are a new investor who is looking at a fresh entry at the present levels, then more or less the worst seems to be over for the company, and the stock also looks kind of bottomed out on the chart unless there is a further fall in the performance of the company. One point to remember is this is not any buy or sell advice. We are discussing this only as a case study for educational purposes, and you are advised to do your own research before taking any investment decision. So this is about Jubilant Ingrevia. I hope you like the simple, crisp analysis what we have done, and you've got a perspective to decide what to do in this particular stock. If you want me to make such videos on your favorite stocks, do drop in that name in the comment section below. And if you're not a part of our Telegram channel, do join today. Subscribe to the YouTube channel. Thank you for watching and have a wonderful day.